Hi, everyone. Welcome to the 124th episode of the Timing Research Show for February 6th, 2017. My name is David Cosmeter. I'm the creator of Timing Research. Today, we will be discussing the 176th weekly report. So if you haven't had a chance to yet, just go to TimingResearch.com/reports. You can download this or any of the past reports there. I have Rob Hanna back to host today, so I'm going to go ahead and turn it over to him.
Thanks, David. Nice to be back again today. Normally I wear a collared shirt for your show, but I thought it more appropriate today to put on my Patriots hat and my Belichick hoodie. So I'm here hosting that way right now. I have Andrew Keene and Jim Kenney here today. And Adam Johnson is going to join us in a minute. I think he was in the room and got kicked out and is logging back again. So we'll get to him in a few minutes. Why don't I give everybody a chance to introduce themselves first, and then we'll get into the meat of the discussion here. So I'm going to go from top down on my list, which is Andrew. You somehow got at the top of my list there, and your picture looks a lot better than the video of me right now with your suit and tie on. So, Andrew, you want to tell us a little bit about yourself and about Alpha Shark?
I can't hear anybody for some reason.
Can other people hear me?
I can hear you, Jim Kenney.
Okay. All right, good.
Andrew, are you still not hearing anyone? Andrew? Jim, do you want to go ahead and go and
yeah? Why don't I start with Jim, and then we'll come back to Andrew later on. All right, hey Jim, how you doing?
I'm doing great. Just a quick background. I am the gentleman who put together the content for the Option Professor DVDs. And what they are is a group of 7 DVDs that take you through the basics, intermediate, and advanced strategies on the options, going over the risk and benefits of different strategies, so that people can understand more about the ins and outs of everything from simple buying of options and rolling positions up or down, or doing writing strategies like covered call writing or put writing, or hedging strategies like collars or married puts and things like that, just so they have a good background of what the heck they're looking at, and then maybe they could apply the appropriate strategy to the appropriate circumstance, after they have better knowledge of how the darn thing works. So basically, that's what I do. I provide the content for the Option Professor.
All right, great. And doesn't look like Adam has joined us quite yet. Adam is also with Option Professor, though. Is that right, Jim? Do you guys happen to know each other?
No, not there. He's not affiliated. No.
Oh, okay. I'm sorry. Yeah. I had it wrong on the list I was given. All right. So we'll figure out.
Right. But I'm sure he's a nice person.
We'll figure out who Adam the Mystery Man is when he gets here. Andrew, can you hear me yet?
I think he's still having audio problem.
Okay. All right. So I'll give a quick overview of who I am in case people are new to the show and haven't seen me before. I'm Rob Hanna. I'm with InvestiQuant. InvestiQuant has been around in a few different forms since 2008. And what I mean by that is it started as Master the Gap, run by Scott Andrews. And then I merged with Scott about 2.5 years ago with my Overnight Edges site. So many people might have been familiar with Overnight Edges or Master the Gap. They are now a combined site called InvestiQuant. I'm also the head at Quantifiable Edges. So I published the Quantifiable Edges, which has been around since 2008 as well. My focus primarily is in swing trading, overnight trading, and now that I'm with InvestiQuant, I'm doing a lot more research with regards to intraday trading as well. That has been a focus of Scott's for years, and so we get into a lot of that. I will. It looks like Andrew jumped back into the room, so let me go to him if he can hear me, and we'll come back later, and I'll tell you
Test.
more stuff later on. Can you hear me, Andrew?
Can you hear me?
Yeah,
Yes.
we can hear you.
All right, good.
All right, awesome. So, Andrew, we're just doing introductions here. If you want to tell us a little bit about yourself and about Alpha Shark, that'd be great, and then we'll start with the hard questions, unless that one is hard.
That's not that hard. Andrew Keene, I was a floor trader at the Chicago Board Options Exchange as a market maker for about a decade. I started AlphaShark.com from KeeneOnTheMarket.com, and basically we have online education where we teach traders how to trade. I trade about 95% of my trades are all equity option based. I use unusual option activity, and I trade with real money in front of people. We have about 350 paid subscribers. Period.
Excellent. All right, let's get to some of the questions here. It's a pleasure getting to talk to Adam and Andrew and Jim again, and we'll look forward to talking to Adam when he's able to jump back into the conversation here. So let's just do a rapid fire for the first question. A lot of times I go into details on this, and then I drag it out too much. So if we could just say whether we are bullish or bearish. Or I guess which direction do you think the S&P 500 index is going to move from Monday's open to Friday's close? Up or down? 2-word answers, and then we'll come back and look for explanations why. So, Andrew, are you going up or down this week?
I'll say down. And my 2-word explanation is It's like 50-50 because the market's really boring.
Okay. All right. Jim, you got a up or down vote right now?
Yeah, my opinion is we opened up at 22.94, and the opinion would be down.
Okay.
And I already got an edge here. It's at 22.89.
Yeah, you're winning so far. I'm going to say up. But we'll come back and explain why in a minute. And it looks like Adam has joined us. So, Adam, you there?
Hey, Adam, can you hear us? Okay, he just disappeared again, so hopefully he'll be back.
All right, you get bored quickly, huh? All right, so let's talk about the whys. You guys can tell me why I'm about to be wrong here this week. Andrew, you wanna start, and I guess give us your confidence level at the end, but give us some reasons why, and then you can tell us how confident you are in your guess.
Yeah, I mean, the market's kind of overlapping, and I just think that the market's a little bit overbought up here. We have some earnings this week, and oil names are really selling off today. I'm long some of those. So I actually am long the market, but I think the market's going lower just because I'm watching price action, price momentum, and it looks a little bit weak today. How much more we can go down? We haven't been moving that much. We have spot VIX trading close to $11 here. So conviction's 50-50. I just think price action, price momentum right now is a little bit weak today.
All right, great. I'm hearing an echo there. All right, that's the spirit. Jim, how about you? What are you seeing that's making you think it's going to be down this week?
There's 84 companies going to be coming from the S&P reporting earnings. People are looking for a quiet week on the news front, but you got some jobs claims. You got the VIX, as Andrew was saying, in that very low area. Consumer sentiment coming up a little later in the week. So there could be some action that people aren't expecting. The gap between 2280 and 2285 looks like it's kind of acting a bit as a magnet today. And the transport's rolling over and the Russell rolling over. I don't think that looks so bullish. So, always a tough racket trying to sell an overbought market, because obviously it's overbought because it has been very, very strong. But, with the up or down question, I'd have to be thinking that it could pull back at least into that gap area.
Okay.
As an opinion only.
That's fine. Do I see Adam again?
Adam, are you back?
All right. Then I'll go and jump into my opinion here a little bit. I'm looking for it to go up this week. A few reasons why. InvestaQuant, our swing edges data, which we look at a number of different things. We look at momentum, acceleration, and seasonality on 1, 3, and 5 day time periods. And then I generally average them together to get a nice broad look at what the short term is likely to do. We are moderately bullish overall, but the 1 and 3 day time periods are basically neutral, and the 5 day is actually looking quite good. So what that is suggesting to me is that we could have some wiggling or some pullback here early in the week, but by the end of the week, it is likely to work itself out, and that we should see a higher close. And that the percentage, or the confidence percent that it's showing on the site is 59.9%, so close to 60%, which is pretty strong. So I like that. I've also seen some studies. I've looked at a number of things in the last several days at quantifiable edges, and one particular study that I found interesting this weekend was I looked at the number of times we saw the S&P pull back 4 days in a row and then rally 3 days in a row. Now, the 3 day rally often suggests you're overbought, and it had sold off 4 days in a row prior to that. And it doesn't sound like it would be that unusual of a setup where you get a 4 day decline and then a 3 day rally. But looking back to 1985, it's only happened 18 times when the market's been above the 200-day moving average. All right, so that's a long-term trend filter in there. 5 days later, it was higher 12 of the 18 times. When you look out 7 days, it was up, or I'm sorry, 8 days, it was up 15 out of the 18 times. So you normally got some kind of continuation of that 3 day bounce. I also looked at it when it was coming off of a 10-day high, and you had that 4 day pullback and 3 day bounce. And you're only looking at 14 instances there, but 11 out of the 14 were higher between 5 and 10 days later. At least 11 out of 14. It was when you get out to 8, 9, or 10 days, you're looking at 12 out of 14. So most of the time, you see some kind of continuation higher when the market's in a long-term uptrend like that. Again, low sample size, but just one example of some of the things I'm looking at here, in addition to the InvestaQuant data, which is suggesting some strong numbers. So that's what's pointing me to the upside today. A sec. And do we have Adam here now?
At long last, I made it. It's incredible.
All right, how you doing there, Adam?
All right, man. I've got this old Apple laptop from 2010, and I guess the problem is I've updated the software so many times it just gets clunky. So sorry for the delay.
Yeah, no worries. So, Adam, can you tell us? When we start off, you can tell us a little bit about yourself. I don't think we've spoken before. So give me a little bit of your background and tell us about yourself, and then we'll get into where the market's going over the next week.
Yeah, cool. Thanks for the opportunity. So I traded for about 20 years, started at Merrill Lynch, and eventually went to a little hedge fund. I started trading oil, then moved into stocks and stock options. And again, spent 20 years effectively looking at companies, markets, very specific company-related option strategies, not really, calling markets per se. And that led me to going on CNBC and Fox, and eventually Bloomberg asked me to join them. So I went to Bloomberg and became an anchor for about 6 years. And now I've launched my own investment newsletter. So it's like, my world of 25 years kind of wrapped into one. And what I do is I find companies with compelling fundamental stories, some data to support the thesis, and then something kind of newsy that if I were still on Bloomberg television, I'd want to talk about, because we're all talking about it. So if I can find those three things together, I write them up, and I put 3 ideas out there every 2 weeks. I publish at bullseyebrief.com. And on the off weeks, I've got a podcast, as well as a Sunday night roadmap for the week ahead, stuff that I'm looking at that I think might move markets and how I will trade as a result.
Okay, excellent. And do you take overall market direction into account when considering your anticipated, I guess, overall market bias into account when considering some of these option trades?
Yeah, I sure do. Although, unlike most options traders, I'm not I think we got Andrew in the room, who's highly technical and can speak Greek with the best of them. I tend to wrap option strategies around a fundamental view on a stock, as opposed to trading the Greeks per se. With regards to what you just asked, yes, you got to look at the market and you got to have a view on the market. Anytime you're putting on a position, whether it's long or short, you just got to have that context. I like the comment you just made about are we above the 200 or below the 200? That's always sort of my my first pass signal.
Yeah, it's a quick and dirty of uptrend downtrend, right?
Yeah, totally.
So looking at this upcoming week, I don't know if you were here for the other guy's answers, but we are currently split. You're either going to make it a 3-to-1, or you're going to tie it up here. You looking for the market to be higher or lower on Friday's close versus today's open?
I'm looking for it to be lower, and I'll tell you why. I know we're not overbought, but the fact that we've got the VIX still hovering as low as it is, that options are so ridiculously cheap, and on down days they won't take it down, is the first sort of alert to me that there's an extremely high level of complacency. I mean, we've all seen the II and the AAII rankings and all that, percent bulls versus percent bears, and it's pretty bullish right now. But I think what's really happening behind the scenes, and this is where I think you need to have a fundamental view and kind of stop, look, listen, and read the papers. I think that the resistance to both Trump's cabinet picks as well as his immigration policy is going to put a real cog in his ability to push reform forward. Even something as simple as infrastructure, which in theory everyone can agree on, Republican and Democrat, that requires tax reform, because you got to pay for that $1 trillion in spending. So I think what we're going to see is sort of a grudging recognition that all this stuff that they've been talking about in Washington is going to take a lot longer than you think. And if you just look at financials today, they're talking about reforming, pulling back Dodd-Frank. I mean, financials should be ripping today, and they're not. They're flat. So it just tells me that there's this slow awakening that maybe this stuff's going to take longer than we think. We've had a big run. There's a lot of bullishness. Options are cheap. To me, that just paints a picture where I think we give up some of our gains and we find ourselves down on the week.
Okay. Fair enough. This actually kind of led me right into kind of the next question here, and I'll go to Andrew. Are there things you're looking for this week, and that could be technical levels or fundamental or political things like Trump resistance, right? Technical resistance or Trump resistance we got going on here this week. What things are you looking for in the news or technically that might have an impact on this week's trading?
Yeah, I mean, earnings is going to be a big one this week, but besides earnings, the S&P is pretty much stuck in a range, and I don't know, it's a coincidence. We got up to 2299.5, so we couldn't get above 2300. We hit that 20,000 Dow, which was inevitable, that people thought we were going to hit. And then one thing I look at is the VIX, and why I've been bullish since Trump's gotten elected, because anytime the market sells off, even the market, reversed today, we're on the lows right now in the S&P, the VIX is trading 1145 in the spot, which is such a low level, and it hasn't really popped at all. So every time the market sells off, we see the S&P down 10 handles, we don't see any spike in the VIX whatsoever. So the complacency is there, and the uncertainty, it doesn't seem like there's really any. So I think that we're going to continue to get bought at any pullback here, and we're just overlapping, and we don't see much follow through the upside, but we don't see a lot of selling pressure. Every time we get sold off, buyers come in and the VIX doesn't pop. So the VIX is the big thing I keep an eye on, and just levels here of resistance and support in the S&P.
Okay, yeah, the VIX is interesting, and Adam mentioned it also. One of the things that I've found curious is how low the VIX is right now, because Trump is certainly volatile as far as personality. He seems to be less predictable than many other presidents that we've had, and you would think it would lead to a bit of a higher VIX, not such a low VIX. And maybe that'll turn out over time, or maybe there's something else going on here that the VIX just has greater confidence. But I find it interesting that we have persisted with such a low VIX. You know, in December it was somewhat expected, but I thought once he came into office and once things start getting enacted or trying to be enacted, you know, there's change. There's always change when there's a new president, and it seems like changes that he's looking to put in. He's using a different style, and some of the things could be more extreme here. And there's been some certainly strong reactions as far as protests and things like that I've never seen before with other presidents, but it hasn't been reflected in VIX prices, or VIX levels, I should say. So I find that curious, and I wonder whether the VIX is going to find higher levels just because of the fact that we have more wild cards in play over the next few weeks, months, what have you. Jim, you haven't gotten a chance to talk. Do you want to? You can either react to that, or you can.
I'm just listening to all these great views here. That's all I'm doing. Well, you know, we had a big jolt from Trump's election, obviously, and the jolt basically from the low that was created during the election night, 2020 on the S&P up to the highs, about 10 or 15% jump. That's a pretty good jump. And the 200-day average you guys are all referring to, if you notice on many of these things like the transports and some of the other indexes, you know, they're pretty well underneath the current prices. So technically, you'd have to say we're kind of overbought, and you'd also have to say that the Trump jolt, you know, is pretty much in the market. Now, the thing that I believe is the big key looking forward is going to be the trade policies and the tax policies. And I think that's going to be the card that turns it into a bust, or turns it into an aces type deal. So I think going into a trading range, 2,300, 2,200 is certainly not a ridiculous scenario here in the short run. And then when they come out with some realities on taxes and trade, then people will place their bets or unwind bets one way or the other. So I think this VIX staying, you know, we just hit the 52-week low on the VIX on Feb 1. We broke 10. And I think there's a legitimate risk of a volatility spike ahead. So I would be, you know, giving a little concern to that, because this VIX in the 10-11 area is obviously evidence of complacency. Complacency might be linked to the trade and the tax policies that we don't know yet. And complacency can turn into a lot of action. And Andrew, being on the floor of the CBOE, knows very well that if you have a volume avalanche one way or the other, and there's no one on the other side, that's how you get these big, large moves through order imbalances. And there's legitimate risk in the next 30, 60, 90 days that an order imbalance could very well hit once we get some news on the stuff that I just mentioned. And that's my 2 cents.
All right, excellent. Yeah, I think this the VIX discussion as well as the range is interesting. You guys have both mentioned the ranges that we're in, and you know, if you look at the Russell, that's been in a tight range for since mid-December. The S&P tried breaking out of its range a little over a week ago, and it didn't really get there. But then you look at the NASDAQ 100, and that's just been climbing and climbing. In fact, it's as of Friday, I think Friday was the 22nd day in a row that it closed above its 10-day moving average. So it hasn't even had like a halfway decent pullback in over a month. And that's hitting new highs. So it's interesting that, you know, we think that the things that are going to be most impacted are areas like healthcare and maybe manufacturing, where you get these large industrials, and they're stuck in ranges, while NASDAQ 100, which is more tech-based, maybe it's just because it's not worried about Trump, but it's going off. Adam, let me give you another chance to jump in. It looked like you were ready to say something.
Yeah. There is a stat, I think, whether I saw it in Barron's or Bloomberg or whatever, that we have not had a 1% down day since October 11th, and that is the longest streak ever. That said, we're all talking about the low.
Was that in what index was that?
S&P 500.
Okay.
Yeah, and by the way, that's going off closing lows. So you can have an intraday low, down 1.2%, but if you close only down 0.8, it doesn't count. So again, we've not closed down 1% since October 11th, and that's the longest stretch ever, which really surprised me. Given all the crazy stuff and everything we're talking about, I mean, the fact that we'd all be so complacent, it boggles my mind. So I decided to put a little bit of money where my mouth is, and even though I hate buying premium because I hate time decay, I went out and I bought about 3-4 weeks ago some of the April, the SPY, April 227 puts. I paid $550. The index is virtually at the same spot. It's like 229, So, okay, fine. It's moved like, 0.75%. And these things have gone from $550 to about $4. Okay, fine. I know that's time decay. But even on the down days that we had early last week, they got up to about $6. Like, there is just like no fear, and market makers have absolutely no inclination to push these prices up, which just shocks me. So, here I am sitting on this thing that I think actually is going to be worth something between now and April, but it's every day it's worth less.
Yeah, interesting. And unlike past, in the past when we've seen these kind of long pushes higher, we've had a lot of liquidity backing from the Fed, right? I mean, it was the QE rallies were bringing us higher and higher, and we don't have that right now. That's
a really good point. Maybe that's why we're not moving up higher. In other words, we're all treading water, but without the Fed sugar to get us juiced, you don't have the the impetus.
Yeah,
that's a good point. I hadn't even thought of that.
Andrew, you want to add anything else before we get into our next question over here, which is going to be on monitoring trading results?
No, I'm good.
Okay. So let's get into that. It was an interesting question that David came up with, which is what procedures do you use to monitor and evaluate your trading results and your progress over time? And you can feel free to expound on that with how important you think it is, or do you think it's important? So Andrew, you can start.
Yeah, so I've been trading full time for about 14 years now. So my risk tolerance is probably a little bit higher than others. So I mean, today I'm down about $4,500, and I have swing trades and I have day trades. The only took that I trade was day trade was a good trade. With the swing trades, I lost money. So I mean, everybody's got to realize what works for them. Some people want to be at their computer 8 hours a day. Some people want to be there for an hour a week. But trade what works well for you. I trade weekly options a lot. Like I traded some MGM options, made about $600. But those are going to move very fast, and you have to really be plugged in. So one thing that's important when you are a trader, you have to figure out how much time you want to devote to becoming a trader. Like I said, some people can be here 8 hours, some people only an hour, and trade what works well for you. I got an email one time. Someone asked me if they could trade Apple on a 1 minute bar. And I said, if you can make money on a 1 minute bar, more power to you. I know I cannot. I can't move that quickly on a 1 minute bar. I can trade a 5 or a 15, but not a 1 minute. So just try to figure out what works best for you, and continue to do that. I always tell everybody that you create a simulated account to start. Why risk your own money if you don't have to? You can get simulated accounts for any of the online brokers right now, and then just basically trade. I trade equity options because I make money trading equity options. I've traded. If futures, forex, stocks, but I go back to my bread and butter, what does best for me, and that's trading equity options.
Okay, great. And is there a specific tool that you use for monitoring trading results, or is it just you follow your different accounts that you have and see there?
So I trade a little bit different. So I watch institutional order flow in the option market. So I watch for big orders trading in equity options space. At least 2 times usual volume, and usually watching between 1,000 and 10,000 options trade. And then I keep like a cheat sheet of every stock I've traded this year, what stocks I've made money and what stocks I've lost money. And I try to, if I see a stock where I made money at Foot Locker last week. If I see institutional order flow again, then I'll trade a little bit bigger. If I see something in like First Solar, I've lost money in it this year, then I try not to trade it. So I keep an individual cheat sheet of stocks that I've made money on and lost money, and I try to just kind of keep with that.
Okay. All right. Excellent. Jim, let's go to you.
Sure. Well, a couple of things that I've learned over time through watching people trade and managers trade and all that kind of stuff. Just real simple stuff, but it's a discipline. And at the end of the day, discipline is very important with this stuff, right? So the one thing would be the per trade risk would be something to keep in mind. How much are you risking per trade? The second thing to keep track of what you're doing is your monthly drawdowns. Are they in line, or are they tremendous? In other words, how are you cutting these things off when they don't work? And then the next one would be the monthly results. And then finally would be possibly modifying the strategy based on how much risk is coming in on each trade, how the monthly drawdowns are going up or down, and then, of course, how the monthly results are coming in. So that'd be 4 areas that if you're out there trading and you wanted to keep a check and balance on your activities, that might not be a bad outline.
Okay. Sounds good. Now, have you always done monthly or
Well, there's no, like I said, there's nothing etched in concrete in this stuff. Yeah. It's a lot of moving parts, and it's a breathing, living thing that we're doing. So these are guideline ideas, and I'm sure there's many others. But there are people who look at things quarterly to give it a little more rope. But unfortunately, sometimes when you give it more rope, you get choked a little harder. So some people like to keep the pit bull on a short leash and bite less of the neighbors, and some people think their pit bulls are so safe that at the dog park they have them roaming around. So it's up to your own cup of tea there. And obviously, the shorter leash you keep something on, at least the equity is going to be watched a little bit closely. But sometimes that can cost you money if you watch it too close. That's why it's not an exact science when we talk like this.
Okay, thank you.
You like that? You like that pit bull thing?
I do. That was funny. I like that. I was thinking about Caesar Milan. That's the guy's name.
The investor whisperer.
Dog whisperer. Yes, you're the investor whisperer. There you go. So, Adam, what procedures do you use to monitor and evaluate your trading results and your progress over time?
Yeah, 2 things right off the bat. Stops and targets. Anytime I put a position on or write it up as a recommendation that my readers take a look at every 2 weeks, there's an entry point. There is a very specific stop loss, which is generally down about 15%, 1.5, and then a target. So I know what I'm looking for when I go in, and in theory when I get out. My mentor of many years, guy is about 80 years old, has made staggering, like hundreds of millions, trading and running companies, brokerage companies. He said, you're only rational once, and that's before you get in. So I try to be rational that first time. I'm looking at lithium right now, and I'm going to write it up in my upcoming Bullseye Brief. It's a fascinating business because it's growing so fast. The great quote from Goldman Sachs was, it's the gasoline of the next century, right? But the reason I mention it is that even the lithium ETF has so little exposure to lithium because so few companies are pure plays. The only way you find pure plays I have learned in my research is to go way, way down on the spectrum to these little Canadian $1 mining companies that frankly scare me to death. But you know, when you look at a position like that, it's going to be inherently more volatile. So in the context of what we're talking about on those stops, I'm actually going to put it down 30%, which would make most traders like, you know, tell me I've lost my mind. And I tend to sort of agree with that. But I think the key also, and this gets to another issue, is sizing the position. So what I'm probably going to do when I write up the lithium is say I'm willing to have an exposure of, say, 2% of my capital to lithium. I'll spread it around 3 stocks that I'm going to hold for probably a year and a half based upon different drilling projects they're doing. And I'm going to make each position only about 2/3 of 1%. Tiny stuff, but you know, I'm also playing for triples and quadruples here. So I think you have to adjust, you know, position size to each position, have stop losses and have targets. Those 3 things going into every position I think are crucial.
Okay, great. All good advice from all of you. And it's funny. I interpreted this question a little bit differently than some of you did. I looked at it from my own perspective as, you know, how do I judge whether my methodologies are doing well over time, and that's kind of the evaluation of my trading results. And this is I didn't realize David was putting this question in there until I saw the question in there. But this is something that I don't know if anybody's read the book Trading Coach by was it Becoming? I can't remember the title off the top of my head. Be Your Own Trading Coach, I think it is, by Brett Steenbarger. And it was like 101 lessons. I was in that book and tackled a question similar to this in that book, where I described how when I first began trading, I would track every single trade and assign a reason to it. And I still group all of my trades by the methodologies I use. So when I first became a trader, I was using day and swing trading methodologies that I learned from books, mostly like Jeff Cooper and Larry Connors, Dave Landry, and I would assign a reason for every trade. So it was a lizard setup or a 180 setup or whatever it was. And then over time, I would see, all right, these are what this is the money I've made and lost in this setup. This is the money I've made and lost in this setup, and I'd look at it setup by setup, so I could see, you know, certain things just weren't providing the edges that I thought they were, and other systems were providing nice edges. And so I learned, all right, let's throw out the ones that don't seem to be working and keep the ones that do. And then I began doing my own system development and moving forward from there. I also, when I wrote for Trading Markets back in 2004 or so, maybe 2003, there was an indicator I used to jokingly call my what's working, what's not indicator, because I did some different styles of trading. I would swing trade, and I would do some intraday trading and some long-term trading. So I would or long-term meaning actually wasn't long. It was more, I guess you'd call intermediate term, breakout style trading. So I'd try and ride the trend. And by just evaluating which of my styles were working, whether that be, you know, I was making money on swing trades, or I'm losing it on my breakout trades, my trend trades, that would tell me we were in kind of a choppy, oscillating type market where the breakouts weren't working. Whereas if my breakouts started working and my swing trades weren't doing as well, that would tell me another thing about the market. So for me, it's a matter of monitoring closely what types of things are working. And I still use many different systems, and I need to know which systems are doing well, which systems are doing poorly. So if a system does poorly for an extended period of time, or it's in a drawdown worse than it has been at any time in the past, I can go in and evaluate it and determine, is it something I want to throw away? Is it something I want to keep an eye on? So then if it starts working again, I'll go at it, or what do I want to do with that system? It's kind of what I do to monitor and evaluate trading results. And it doesn't take a whole lot of complex software or anything. You can use Excel and just, as long as you have every trade written down and a reason for it, you're good. And when I was a beginning trader, the one thing I learned pretty quickly by doing this was that if I didn't have a good reason for a trade, for instance, I would trade something on a hunch, or it was something I read somewhere, but it wasn't a setup I typically traded. That was the group that I lost more money on than any others. So it quickly taught me discipline, that my setup had to be there before I would trade it. So I encourage people to monitor the results closely, and you will learn from your own results. That brings us near the end of the show today. We've gone through quite a bit. What I'd like to do is go through, and you guys can give me a summary of. I'm sorry. You can tell me anything you want to tell me about your sites, and we'd like to get one trading idea from each.
Oh yeah. Okay. Go ahead.
From each person, if you got a trading idea for this week, that would be great. Andrew, you want to? No, I've been starting with you the whole time. Forget you. You can go last. How about Jim? You've been going last a lot. Jim,
right.
you want to tell us anything going on there at Option Professor?
I just wanted to give an opinion out on a few different things real quick. I'll
Sure.
just be very brief on it. There's 6 things that I kind of keep an eye on. So I have just an opinion on a few different things here. On the stock market, we closed at 22.75 last month, and obviously we traded up a little bit from there. There's a report, I guess, tomorrow, I think it's tomorrow, called JOLTS. And when I saw that report came out, it's exactly how I felt about how the Trump situation has been. And it's been a jolt. So the thing here is that there's policies on immigration and trade and on tax policies that are coming down the pike, right? And we don't know exactly how they're going to pan out, really, right? But we do have some information or some experience with the immigration policy, right? And these are policies of change. And every time you have an action, you're going to have a reaction. And I think no matter where you fall on the immigration issue, the implementation of this policy change has not exactly been the best. So is that giving us a tip of the hand how much of a, shall we say, dispute there'll be when he tries to do tax and trade policies? And is there going to be reactions that we're not aware of that could be very significant once he tries to do these things? Because obviously his first bite at the apple, immigration, seems to have a few worms in there. So that's the one thing on stocks that I'd want to keep an eye on. Maybe we're trade range bound for a bit here, but I think once we get more cards out there on the trade and the tax stuff, people are going to start making some bigger decisions than up or down 1%. Like Adam was saying, 1% a day. I mean, these are not ordinary things. And the VIX hanging around 10 or 11 is not what they call the norm. So things that are not, normal tend not to last forever. And the option writer has been doing very well. And if you have traded any length of time, option writing is not a risk-free enterprise. So at some point, they do get whacked.
Not much in trading is.
That's right. But you can't bet black forever. So the bottom line is that the winds of change tend to blow, and the longer this thing goes nowhere, the more likely it doesn't become less likely the winds of change will blow. We're getting closer to when the winds of change will blow. So on the stock market, knowing strategies like how to use a collar, how to use a put hedge, I don't think is the worst thing to look into while it's still sunny out. The bond market, I think nobody talked about. I think it's a big deal. I think this 2.60 area on the 10-year is a huge deal. If you started seeing the 10-year at 2 3/4, 3 1/4, that is going to attract some interest out of stocks, in my view, possibly. Okay, so keep an eye on that. U.S. dollar started to weaken a little bit. Then the euro came out. Draghi comes out, starts talking about more QE, and then it starts picking up some steam. Value of the dollar is going to be pretty big. Oil, I guess someone was saying, is slipping a little bit today. We got oil inventories and rig counts coming up this week, so keep an eye on those two reports for the oil. And then I think the bigger story nobody's really talking about is there seems to be a little bit of a turn in the metals from January. We were up $58 in gold in January and $1.57 in silver, and they've added to those this month so far. And if we were ever to get above $1,400 or $21 silver, there could be a wind of change going on there that could be pretty significant. So keeping half an eye on that. And then one of the things that might get affected by the trade situation is the price of agriculture, because we do a lot of international business. And obviously, if people wanted to get back at us in some retaliatory fashion, agriculture prices could be affected. And of course, the price of soybeans would be one of the main ones to keep an eye on. So I just wanted to give a little bit of, like they say, around the horn on some of the different markets that people might want to keep an eye on. And again, those are strictly my opinions, and obviously people out there have many different opinions. As far as Option Professor, if you'd like to know more about all the different strategies out there, find out what might be appropriate for you, what might not be appropriate for you, understand the use and the risk of these things, then Option Professor does have these DVDs that are very helpful in your education process. And of course, I do invite people to check those out. Okay, that's all I got.
Terrific. Thanks for coming to the show again, Jim. It's always a pleasure getting to talk to you. And I think you win the award today for best analogies. You had me cracking up. All right. Adam, let's go to you. I was just thinking, you brought up a couple of good points that we didn't necessarily. We talked about a couple of things that we didn't necessarily connect, and one of those was the fact that you mentioned there hasn't been a 1% down day in the S&P for October 11th, I think you said.
Yeah, October 11th. It's mind-blowing.
In fact, we've got a persistently low VIX, so maybe, of course, the VIX should be low. We don't have any big down days, right? If there's never going to be a big down day, why would you pay a lot of premium on options?
So I'll tell you what's amazing. I'm looking over here at my. Oh, look at that! I hit the wrong button. On my my Bloomberg terminal. Isn't it crazy? I pay like, what do I pay? I mean, it's like $2,100 a month for this Bloomberg terminal. If anyone's got an idea about how I can save some money and trade with something else, please let me know. But I do love this thing. So so I'm just pulling up my options montage on the SPYs, and seriously, this is insane. Okay, the implied vol on the Feb at the money puts, which expire, by the way, in 11 days, so I'm not sure that's the one you want to own. 798. 798 implied vol. I don't even remember the last time I saw 798. Anyway, you look at the Aprils, in April at the money, right now it costs you, well, okay, the index is at 228.66, so call it a 229. You're in the money by about 40 cents. That thing costs 410, which means you're paying 370 in premium. That's like $9.79. I mean, it's just so cheap.
Yeah. Pretty amazing. So let's. I'm sorry, I hear echoes in my ear. If you want to give us any additional information,
it's that pixel we're talking about.
If you want to give us any additional information on Bullseye Brief, that'd be great, and give us a trade idea for the current week, or the one that you're holding longer. That'd be great as well. Though I think you already did mention lithium, but if you wanted to go further.
Yeah, lithium. I'm researching, and I'll be writing that up in the Bullseye that's going to post on Sunday morning. I distribute to about 2,000 people. I send that thing out about 7 a.m. every other Sunday, so you can read all about lithium. Just go to bullseyebrief.com and sign up. I have a 30-day free trial. Let me give you another trade, and this is one that's currently written up. I posted this one starting 10 days ago. It's a company called Ectelion, which is in Switzerland. It's being bought by Johnson & Johnson. It's a cash deal. They're going to pay $280. It's trading right now at $258. It's scheduled to close on or before June 30th. There's also a dividend in there of about $1.80. And holders of the stock are going to get a stub because the founder of this company didn't want to just like go off with his literally $1 billion and do nothing. So they're going to give him a research and development company. That's probably going to get priced at about $7. So you look at the deal spread, 280 less 258, that's $22. You get a dividend of $1.80. So now you're at $23.80. And then, you get this stub that's worth, in theory, $7. That's its own, free trading new share. So, that works out to about a 20% annualized return, a little more actually, between now and June 30th. And with all this talk about, Trump this, Trump that, tax reform, Mexico, noise that frankly none of us can predict, I kind of like deploying some of my capital in names that are completely uncorrelated with all that stuff. And here is a cash deal that is booked up very solid. And you know what? I just want to park some money there and collect a 20 plus annualized percent, 20% annualized return, between now and June. Fine, thank you very much. I mean, if I could do that every 3 months, I'd be thrilled.
I think we all would.
Yeah. So Ectelion, that's you can see it on my site, bullseyebrief.com. It's written up there now. I just click on it and you can find out more. But there's a trade idea for it.
All right. Thanks, Adam. Great to get to talk to you and meet you and learn a little bit about what you do there.
Yeah, thanks for having me.
Andrew, you have you've been the happiest guy the entire time because I've been looking at your picture, smiling at me the entire time. What you want to tell us anything else about Alpha Shark and if you got a trade idea that we can look to take advantage of, that'd be great.
Yeah, so like I said, my trading style is a little unique. I watch institutional order flow in the option market. We run one of the biggest live trading rooms in the world. It is 8 hours of audio and visual. I am personally on for the first 2 hours of the day, trading live in front of everybody. I was up money this morning. Now I'm starting to get crushed because Oxy's down. And I basically trade institutional order flow. I'll throw one out there. I'll say finish line, FINL. So a institutional buyer of the March 18 calls about a week ago. They were buying calls in Finish Line and Foot Locker, which is kind of interesting, maybe like a merger or acquisition there. So I'm long these calls. I added to the position today. It is down money. I do agree with Adam where I'm in the principle of I don't really want to buy premium, but I can't possibly sell it here. So it's kind of like no man's land. As a trader, volatility creates opportunity. We just haven't seen the volatility. As we just watched the market just rally back 2.5 points in S&P in the last 20 minutes. It just seems like every opportunity to buy the dip is continuing to work. So it's a hard environment to trade just because the volatility is not there. I think volatility will pick up. It could be in 6 months. It could be in 2 years. I don't think it'll be in the next month or two. But that's what I'd trade. And if anybody has any questions about my trading style or anything else, they can always get a hold of me at andrew@alphashark.com.
Excellent. Yeah. Thanks, Andrew. Good talking to you again. And I will close it out here and let you know that you can always contact me at rob@investaquant.com or you can contact me at support@quantifiableedges.com also. And you can take a free trial at quantifiableedges.com, and there's a lot to look at over at InvestaQuant. We've got not only a lot of information for traders. We've also got automated systems that we've begun producing in the last 8 months or so that you can use with your on TradeStation and Ninja, or we're affiliated with a number of brokers now that you can have your stuff auto traded out as well. So some interesting opportunities for people that haven't done this style of trading yet, but would like to kind of diversify and do some intraday trading. My trade idea is probably not going to be nearly as exciting as the one I had last month. Last month I said GM and it went up 5% the next day, so that's not going to happen with this one. I'm looking to get long QQQ on a pullback. So as I mentioned earlier, it's closed above the 10-day moving average for 22 days in a row. Looks like it's going to make it 23 unless we get a steeper pullback here today. But I'd be looking to buy that on the first day it closes below the 10-day moving average and hold for a few days till it swings right back up. Rarely do such persistent trends end abruptly. Normally you get a rounded top and not a V-ish top. And a lot of dips have been buyable lately, so I'd like to be buying the dip in the strongest indices and the strongest trends, because they are less likely to crater when immediately on the next dip. So that's where I'm looking to get in. Any close in QQQ below the 10-day moving average, and then I'd probably get out on a bounce when it moves back up into, say, the top 20% of its 10-day range, or if it's wiggling around a few days, I might move a stop up below the low and see if I can ride it a few days. But generally, I get in when the data looks good. I get out when it looks bad. The data still doesn't look too bad right now on QQQ based on InvestorQuant readings, but a lot of times, if you start to get too overbought, then short-term data will recognize that and it will pull back. Anyway, that's where I'm at, and I look forward to coming back again in the future, David. Thank you for having me and the guests. And I guess that's a wrap for today, pretty much.
Yeah.
Oh, go Patriots!
Yeah, great show. So just want to remind everyone watching to be sure to hit the subscribe button for YouTube to make sure you get updates on future shows. You can also go to TimingResearch.com and you can download any of the past reports or watch any of the past shows there. Be sure to join us next week. Rick Sadler, Kurt Christensen, James Romelli, and Dean Jenkins will be on. And I just want to thank all my guests again for the show. Andrew Keene of AlphaShark.com, Jim Kenney of OptionProfessor.com, Adam Johnson of BullseyeBrief.com, and Rob Hanna of InvestiQuant.com. Thanks, guys.
Thank you.
Thanks.
Thanks.